Imagine this: 11 countries sitting around a table, shaking hands, signing trade agreements, opening up new markets, while the United States waits outside the door, not invited. This is not a scene from some drama about politics. It's real life, and it could change America's economic destiny. A few months ago, Canada signed significant trade deals with 11 nations, among them Australia, Japan, Brazil, and the United Kingdom. The US was not at the table. Imagine your best friend throwing a decadent dinner party, then serving you leftovers the next day. The stakes are staggering. Over $780 billion in trade per year could now be diverted away from US companies. 6 of the country's largest sectors, from energy and agriculture to retail and technology, are already beginning to take the hit. What if I told you that US distribution centers are closing, auto plants are desperate to stay open, and some communities might see their last economic lifeline diverted abroad? It's not a threat on the horizon. It's happening now. Before we analyze which companies are most at risk and why, make sure to like and subscribe if you're concerned about where the US economy is headed, and don't miss the next installments of this developing story. Because if Canada is moving away from its closest friend, the actual question isn't what America lost, it's what happens next. Now let's take a closer look. Envision a line of 18-wheelers spanning the US-Canada border, headlights illuminating at sunrise. Every truck filled with American products headed to Canadian store shelves. For decades, it has fueled one of America's largest retailing behemoths. 47 distribution hubs strategically located for speedy delivery, creating more than 18,000 US jobs, all funded by Canadian demand. But that line of trucks is slowing. Canada's new trade agreements, signed in the first quarter of 2025, have reshaped the rules. Countries like Japan and South Korea now have preferential access, which means they can send electronics, homewares, and even food directly into Canadian shops. No US middlemen, no American markups. The retail giant that seemed invincible is now in trouble. In-house reports forecast a whopping 23% loss of Canadian market share. Warehouses are being considered for consolidation. Layoff strategies are being secretly written up. And Wall Street has already had its say. The company's stock fell 8% the same day the deals were made, its worst one-day decline in more than a decade. This is not merely lost business. When a whole supply chain depends on one relationship and that relationship breaks down, it's not only revenue that disappears, it's infrastructure, it's employment, it's whole communities. Canada didn't shut one door. It pulled out the foundation of decades-old business planning, and the destruction doesn't end at the retail level. For decades, Detroit has been the pulsing heart of U.S. manufacturing, humming assembly lines, steel presses, proud factory workers punching in each day. At the hub of that heritage stands one of the country's biggest auto component manufacturers, its products powering vehicles throughout North America. Their secret? A tightly stitched supply chain. Michigan-made precision parts shipped to Canada to be assembled, and then back to U.S. factories as finished systems. It was a smooth ballet of cross-border commerce, until now. Because Canada's new bargains have opened wide the doors to competitors from South Korea and Japan. These are not only trade partners. These are countries with world-class auto industries, and, most significant, brand-new tariff benefits. Now, a Canadian automaker can buy brake systems from South Korea at 15% below what they would pay from American manufacturers. That's not competition. That's a knockout punch for U.S. firms already running on razor-thin margins. Behind closed doors, the shift is already in motion. South Korean firms are proposing joint ventures with Canadian plants. Japanese executives are walking the floors of Ontario factories, measuring space and planning expansions. Boardroom memos cautiously call it a strategic disruption. But industry insiders, they're calling it what it really is, an existential threat. This American automotive empire didn't merely sell to Canada, it built with Canada. That dependence was once its biggest asset. Now, it is a blaring weakness. When this supply chain breaks down, it won't only grind assembly lines to a halt, it will ripple through steel makers, electronics manufacturers, and thousands of employees from Pennsylvania to Texas. What happens when the very heart of North America starts to freeze up? Let's change gears. Over the rolling cornfields and endless fields of wheat in the Midwest, American farmers have had one steady lifeline, transporting their crops north to Canada. Wheat, soybeans, corn, billions of dollars worth of crops crossing the border annually, and one mighty agribusiness conglomerate has held sway over that pipeline for decades, arranging almost one-third of U.S. exports to Canada, until recently. During the first quarter of 2025, Canada negotiated trade deals with farm giants such as Brazil and Australia, countries growing the same produce, cheaper, and now having privileged access to Canadian markets. The effect? Catastrophic. Australian wheat comes into Canada at a 12% cost savings. Brazilian soybeans are waved through at the border, while American cargo remains stuck in red tape. For this farm titan, it's not only a matter of losing business, it's a breakdown in the entire system. Grain elevators, processing facilities, shipping terminals, these huge investments only pay if volumes remain high. But volumes are now cratering. Canadian customers are canceling contracts once believed to be set in stone, diverting orders abroad. Farmers in North Dakota, Montana, and Minnesota, where as much as 60% of export income relies on Canada, are seeing their prices plummet. In its most recent earnings call, the company planted a heart-stopping sentence in its report. Volume declines in northern markets could require facility consolidation and workforce optimization. In English, layoffs, factory shutdowns, rural communities smothered by a market that was once thought invincible. This isn't economics, it's generational, and if this domino falls, the heartland will begin to empty out. But the crisis doesn't end at factories and farms. On both oil fields and boardrooms, there has been one term governing U.S. strategy for decades: North American energy independence. For one of America's largest energy behemoths, however, never was it about genuine independence. It was about interdependence with Canada. This firm constructed its empire upon Canadian crude flowing south into U.S. refineries, and natural gas fueling millions of American homes. Canadian energy flowed through U.S. pipelines for years like lifeblood. But with Canada's new trade alliances sealed in early 2025, everything is different now. Now, it's Norway, and the UK stepping in with cleaner technology and more advanced infrastructure. But the surprise twist: Australia. In contrast to the US, Australian energy companies aren't merely exporting raw materials. Australia is assisting Canada in establishing its own processing capacity. That leaves the jobs, the revenues, and the sustainable growth all north of the border. And the consequences are already beginning to bite. Internal figures indicate a 34% collapse in Canadian crude deliveries into the US over only 18 months. Pipeline revenues are evaporating. Refinery runs have fallen below 67%, a rate analysts consider untenable. Shareholders are in meltdown. The company's shares have already dropped 15% since the trade agreements were announced. Panic restructuring plans are now being scrambled into action. This American energy giant never thought about a day when Canada would cease to send oil south, but that's what's happening now. Its whole model of pricing, based on supply stability, is coming apart. Because when your best ally constructs a better bargain without you, you don't merely lose profits. You lose your foundation. And energy is not the sole battlefield. Over the last 2 decades, one of Silicon Valley's tech titans quietly emerged as the infrastructure of Canada's cyber existence. On any given day, over 800 million transactions, ranging from health records and bank transfers to government files, passed through its American-based servers. The rationale was straightforward. American networks were speedy, secure, and domestic. But that thinking is being dismantled. Canada's new trade agreements, signed in early 2025, are remapping the digital landscape. Nations such as Singapore, Switzerland, and South Korea are providing speedier, lower cost, and more direct international links that sidestep American infrastructure entirely. The biggest bombshell? Canada is installing fresh trans-Pacific data cables that will route around the U.S. entirely. The ramifications are immediate. Internal projections are estimating a 28% reduction in American network usage by Canadian customers. The revenue from Canadian data services, one-time $1.8 billion annually, now hangs in the balance. But it's not merely a matter of lost bandwidth. This firm constructed an empire based on the presumption that Canadian data would forever travel through American pipes. They purchased data centers, staffed up, and built infrastructure based on that singular premise. Now, Canadian schools are directly connecting with Japanese AI research centers. Canadian banks are aligning with Swiss financial networks, bypassing U.S. middlemen altogether. Government agencies are choosing data sovereignty over U.S. cloud infrastructure. The digital border is closing, and for this American technology behemoth, the future isn't just in doubt. It's already being redirected. Change the scene. Steel girders clang. Conveyor belts whir. Hard, hat-clad workers move in deliberate steps. For decades, a single American manufacturing conglomerate symbolized industrial dominance. With plants along the Rust Belt, the South, and the Southwest, it was not merely a firm. It was the spine of American production. And at its center stood Canada, its most significant customer. Canadian sales used to generate $2.7 billion annually, not only in finished products, but in raw materials, parts, and industrial services. This wasn't a straightforward trade. It was integration deep. American parts supplied Canadian assembly. Canadian tools supported American production lines. They constructed a continent together. But now, that same integration is its biggest vulnerability. When Canada inked its blockbuster new trade agreements in early 2025, the scales tipped overnight. Overnight, Japan, South Korea, and Australia were selling high-end factory equipment, shipbuilding technology, and mining gear, with nary a need for American middlemen. And they're not just competing, they're partnering. Swiss-German alliances are providing Canada with the leverage to circumvent U.S. suppliers altogether. Japanese companies are even suggesting moving ultimate assembly lines out of American factories into Canadian plants, sited nearer to the new Pacific trade corridors. Leaked strategy memos from one of America's big manufacturing players show the panic. Canadian plant integration, redundancy planning accelerated. Workforce transition scenarios already being worked up. Plain English? Layoffs. Plant shutdowns. A gradual unraveling of American industrial cities once constructed on cross-border collaboration. This is not merely about foregone sales. It's about a whole manufacturing system drifting toward obsolescence because Canada discovered 11 better offers. And what you've just heard? It isn't a forecast. It's already happening. 6 American giants, each tied to Canada through decades of infrastructure, strategy, and trust, now face a new reality. A world where being neighbors no longer guarantees being partners, where loyalty is being replaced by leverage. When Canada shook hands with Australia, Japan, Brazil, South Korea, and others, it wasn't just signing trade papers. It was redrawing the global map. And here's the surprise. This isn't about standalone firms. It's about full systems. When that retail colossus closes distribution centers, trucking drivers disappear, warehouse employees are terminated, and the diners that feed those workers grow silent. When the auto parts empire forfeits contracts, Pennsylvania steel mills lose orders, Texas electronics manufacturers lose orders, Midwest farmers, their crops remain unsold. Experts put direct U.S. business at $11.2 billion in jeopardy, with spillover effects taking the total loss above $26 billion, and that's only from these 6 firms. But perhaps the scariest question isn't what we already lost, it's what's next. If America's best friend, Canada, can silently shift, what keeps Mexico from doing the same? What keeps Europe? What happens when made in the USA is a less competitive offer in a more powerful, more diversified global economy? It's not just a trade disruption, it's a whole generation change. And we're seeing it happen in real time. So, before the next domino tumbles, hit like, tap subscribe, and join us as we expose the aftermath of one broken alliance and the empire that could crumble.